This week focuses on Chapter 9, which is banking. And so the first thing in that I want to show you is what's called a deposit slip. And whenever you deposit money into your bank or credit union, or if businesses deposit money, they fill out what's called a deposit slip. So your deposit slip is comprised of different sections. At the top you have the credit union or the bank name that you're depositing to. You have the date, the name of yourself or the company. And then on the top right here, and I'm sorry it's a little bit hard to see here. Let's see if I can zoom in a bit. Yeah, it's not letting me zoom in. But here we have any cash. So this includes dollar bills and coins that you're depositing. In this case, we have $300 worth of currency and $60.49 worth of coins. And then we have a really small section for checks that we're depositing. In this case, we just have 3 checks, $250, $125, and $216. But below that, it says total from other side. And so with a lot of businesses, they deposit multiple checks at a time. And so 3 spaces isn't enough for them. So in back of that deposit slip, there's a section for them to add more check deposits. Okay, so all of those checks are listed here. Okay, it's separated by each individual dollar amount, the cents, and then we also total this section from the back side of our deposit slip. That's where we get this total from other side. Below that we have the total. So the total is all of the cash, currency, coins, and all of the checks that we're depositing. Okay, and then we also have our net deposit. Okay, and so usually with businesses, because they have multiple checks, they don't just hand the cashier or the teller, a stack of checks. They include this deposit slip and usually a printed calculator tape of each check totaled. Okay, here's an example of a check just with the stub on the left. And so I'll talk about the check first. So we have the business name. If it's a personal check, it would have our name at the top because we're the ones writing the check. You have the check number on the very top right. You have the date, who we're writing this check to. Okay, the dollar amount in numerical form as well as in written form. Here we have the memo section, so it's just a brief description of what this specific check is for, and then the signature of the person who's writing the check. And then at the bottom here you have the routing number and also the account number as well as the check number itself. Okay, so this check stub on the left side here, this is usually saved by the company who's writing the checks. In this case, Hart Furniture wrote this check, and they keep a copy of this stub, which is just a mini record of the check that was sent out. So it has a check number, in this case 2506, in the amount of $124.35 on September 24th. It shows who that check was written to, also what it was for. Okay, here we have the balance forward. So the balance forward is the amount in the checking account before we wrote this check. So in this case, it was $1,332.80. If for any reason we also deposited money, that would be included here in the amount deposited. So let's say we had another transaction where we deposited $1,160.49. We would then total that because deposits are added to our bank accounts. Below that we have amount this check. So the amount of this check, which is $124.35, and the balance carried or the balance forward is our total minus our check because it's moving out of our bank account. And so our balance forward in this case is $2,368 Okay, sometimes you might have a check with a check stub on top. So here's just another example of a $300 check. We have the balance forward. If there were any deposits, they'd be listed here. We then have a new balance after the deposits. We also have a section specific to this check. So this check was written on October 1st to Men's Warehouse for suits and slacks. And then on the right side here, we have the new balance that we calculated after any deposits. We also have the amount of this check, in this case $300, and the new balance after this $300 check is $1,255.08. So a lot of small businesses and many individuals still use a check register, and this check register provides a place to record information about each bank transaction, specifically checks that are written. So if you take a look at your check register, starting from the leftmost column, you have the date, and so the date is just the date that the check was written or the date that a deposit was made. So if we wrote out a check, we would include the check number. Okay, and then in this column it says checks issued to or deposits received from. So this is just a little description of who we sent our check to. So we sent checks to Ace Auto Repair, Morton Window, and so forth. And if we received any deposits, we would list that here as well. So here we deposited some cash, and we also deposited some cash on October 20th. Okay, so notice that we also separate the checks that we wrote and money that we deposited. So if you've taken accounting, you should know your debits and credits. And so for some check registers, instead of saying amount of check or amount of deposit, it says debit and credits. So debits decrease the account. So this column here gets subtracted. And credits increase money in your account. So these would be your deposits. And now taking a look at the balance on the far right column. This balance of $1,332.80 was our bank account balance prior to September 24th. Okay, so let's say we started out with this $1,332.80. After this first deposit of $1,160.49, because we added this, because it was a deposit, our new bank balance was $2,493.29. Okay, we would then record this $124.35 check that we wrote. Because this is money that we are moving out of our bank, we subtract $124.35 from our balance. Okay, and that gives us this amount. And then we just keep subtracting our debits and then add any credits such as deposits. Okay, so again, your check register is just a nice record of all of your checking account transactions that you make. Another banking document is your bank statement. So your bank statement is issued to you on a monthly basis from your bank. So most of us who have banks and credit unions, we get our bank statements at the very beginning of the month, and it has all of the transactions from the previous month. And what your bank statement shows is first your opening balance. Your opening balance in this case is called previous balance. So it also tells us that this statement covers 9/21 through 10/20. So prior to this statement, our bank balance was $1,332.80. Okay. In addition, it also lists any deposits that were made during the month, any withdrawals that we also made. So this includes ATM withdrawals, purchases, or checks that we wrote. if we earned any interest from our bank account, that would be added here as well. Okay, we also have monthly checking fees and other charges would be included here. And so our new balance is $1,805.36. So our previous balance adds any deposits for the month, it subtracts withdrawals, adds interests, and subtracts any fees and charges. And that's what makes up our new balance. In this example here, we also have a minimum balance. So this just tells me that $980.17 was the lowest that our account had during this time period of 9/21 through 10/20. And it also shows us our average balance for that time period. Okay, so below our summary, we have checks and withdrawals. So here we have each check listed that we wrote out, the date that it was processed through our bank, and the amount for each check. If there were any ATM withdrawals, that would also be listed here. Point of sale purchases, so in this case it shows that they went to Safeway and Chevron on October 9th and 10th. And there were charges in $132.50 and $74.38. And then if there were any deposits, they would be listed here. So here it shows that the customer deposited $1,160.49 on the 25th. And let's say that there was an electronic funds transfer. So somebody automatically transferred money into the account. That would be listed here as well. And so a very important part of business banking and even personal banking, so even in the age of debit cards and electronic records, it's still important that you are aware of what's called reconciling your account. And reconciling your accounts are just making sure that your records, specifically maybe your checkbook balance or your check register, matches what's showing on your bank statement. Okay, and so I'm going to see if I can zoom in a bit here. And so I'm going to start with number 1. And I apologize, it's a little bit hard to see, but the first step of reconciling your checkbook register with your bank statement is to first check off the checks appearing on your bank statement. Those checks not checked off should be recorded in the checks outstanding column. So normally in your check register you have an extra column, and it's really small, and then it's a little place for you to just put a little check mark next to the checks that have cleared in your bank statement. And so here if we see we got 2506, 2507, 2508, and 2509, and then checks 2514. And so if we take a look at here, we have checks 2506 to 2509, but check number 2514 wasn't recorded in our bank statement. Okay, so we wouldn't put a little check mark next to that last check that was written, 2514. Okay, and so if there were any other checks that were not checked, so any checks that weren't listed here but were listed here in our check register, you would write them in the checks outstanding column. And that's this section here on the left. And outstanding checks or checks outstandings are checks that you wrote and recorded in your checkbook register, but they haven't yet been paid by the bank. So it does take a few days, if you mail a check in to somebody or a business. And so you might also have some processing time. Banks process times differently. And also maybe somebody is just waiting until they have the time to go to the bank before they have a chance to deposit it. Okay. Then from your check register, you would enter your checkbook balance in this section. If you had any credits made to your account, so this includes interest earned in your bank account. This could also be electronic funds transfers, so payments that were automatically sent to your checking account but you didn't record. That would be added to your checkbook balance. So in this case, we have, let's say for example, a $6.30 interest that we earned in our checking account, and also $400 that we earned as an EFT transfer. We would then subtotal them, so we're adding the $6.30 and the $400 to our initial checkbook balance. And then here it says to subtract any debits made to your account through debit card, bank charges, account fees. And so these include, as it states, things such as service fees. Sometimes there's a check printing fee, insufficient funds checks. Okay, any service charges or fees from the bank would be included in the subtract section. So you would total any of the debits, and then you would get your adjusted checkbook balance by subtracting them from your subtotal. Okay, step 3 says the bank balance shown on the statement. And so here, our new balance was $1,805.36, which we got here. And then below that, it says to add deposits shown in your checkbook, but not shown on the statement because they were made and received maybe after the date on the bank statement. And so let's say in this case we had $980 worth. After adding that to our bank balance, let's say that gave us $2,785.36, we would then subtract the outstanding checks that we did in the very first step, and that would give us our adjusted bank balance amount of $2,229.24. And so it's really important when you're reconciling your bank statement with your checkbook register, okay, that your adjusted checkbook balance equals your adjusted bank balance.